You're listening to The RealWealth Show with Kathy Fettke, the real estate investor's resource.
There's been a lot of uncertainty out there today in the financial markets with Omicron, inflation, potential rate hikes, and now a war in Ukraine. So how can investors make good financial decisions when they don't know what's coming next? I'm Kathy Fettke, and welcome to The RealWealth Show. Our guest today may give us some insight on this topic. Michael Fratantoni is MBA's chief economist and senior vice president of research and industry technology. He's responsible for overseeing MBA's industry surveys, economic and mortgage originations forecasts, and policy development research for both single-family and commercial multifamily markets. And he's here today on the RealWealth Show to help us understand what we're facing in 2022. So, Mike, welcome. It's great to have you here.
Thanks for having me. I really appreciate it.
Now, you just got back from a multifamily conference. I just got back from a commercial real estate conference. Let's start with you. What did you learn at your conference?
Yeah, so our CREF conference, it was a very, very optimistic crowd. So we put out our forecast that, we think after a $900 billion commercial and multifamily lending year in 2021, we think in 2022, we're going to crack $1 trillion of commercial and multifamily lending. A lot of that's coming from just, incredible growth in property values, particularly on the multifamily side.
Well, that's incredible. I was just telling you offline that I was on a debate at the Best Ever Conference in Denver. It's mostly commercial investors. And I was put on the side. I didn't get to choose that it would be lower volume this year than last year. And we somehow swayed the audience, even though it's not actually how I thought it would go. But one of the things I had said is, probably the Fed will be raising rates and that could impact the market. But after Jerome Powell spoke to the House today, that it looks like maybe we're not going to be seeing a lot of rate hikes this year. What
I heard him say was, definitively 25 basis points at their March meeting, which will be announced on March 17th. And then, going back to their prior meetings, they had been signaling 3. And if you listen to Fed speeches, 3 or 4 this year was sort of the likely betting from Fed officials. Wall Street was saying 7 or more and was looking for 50 basis points in March. I think what Chair Powell has done is sort of walk that back a bit and say, okay, we're going to be cautious. Nimble is sort of his word of the hour here. We're going to be paying attention to what's happening in Ukraine, paying attention, obviously, to the inflation and job numbers here in the U.S., but there is a need to raise rates, but I think they're going to do it sort of methodically and no big jumps.
Sure, there's so much uncertainty right now. And I believe I heard, and again, this is all new, but that the GDP forecast went down as well. Did you hear anything about that?
So, in thinking about the impact of the Ukraine situation, essentially you're taking the 11th largest economy in the world offline, right? You're removing it from the global economy for a time. Macroeconomic thinking would say that's going to have 2 impacts. 1, it's going to slow global growth. 2, it's going to raise inflation globally, right? Because with less trade, less ability to bring costs down, that's going to be inflationary. So I think that's a reasonable expectation from this, but I think, you got to be honest here. There is just so much uncertainty, and that's what the market's telling you right now with these wild swings in stock market prices and wild swings in interest rates right now, is that there is very far from any consensus about where we're headed over the medium term.
Well, what we know is oil prices are up, right? At least there's inflation there. Do you think, this is not real estate related, so you don't have to answer, but do you think that we will become more energy independent, that we'll get pumping back up in North Dakota? I mean, what do you see that happening at all?
It's cross-cutting, pressures, right? So the markets and oil prices would say there absolutely is a need to increase, and there would be a healthy return to increasing drilling here. But, the concerns around climate change and ESG and, dollars being funneled away from domestic oil companies would suggest that they're having an ever harder time getting the capital they need to do that. So it's not going to be a short run fix to pump more in the US. We've become, I think, more reliant on imports than was the case just a few years ago.
Interesting. Okay, we have some land up in North Dakota, so I wasn't sure if we'd start to see it booming there again. Only time will tell, right? So much
Exactly.
uncertainty. Okay, well, at the conference where I was, there was tremendous optimism, shall we say, just like you said when you went to your conference. One of the things that concerns me a bit for multifamily, I know there's massive demand for housing. What I'm also seeing is a lot of newbies coming in, just maybe not understanding some of the challenges that can come with owning multifamily property and not, putting that into their pro formas. So would you say that the multifamily sector is overbought or there's room to run there?
Yeah. Well, first looking at the fundamentals, rental vacancy rates are as low as they've been in the last 4 decades. That is spurring rent growth, depending upon which measure you look at, from sort of mid-single digits to mid-teens. Again, extraordinary for just looking at net operating income of these properties. That's in really good shape. And then you get to the outlook, right? So when these properties are valued, those cap rates have gotten to ever lower territories, and to really justify that, you need that NOI growth to continue for a long time. And then also when investors are comparing putting their money into multifamily assets versus something else, when risk-free rates go up, that gets harder to make that decision, right? And so all the talk we were just having around where the Fed's likely to head and what the impact's likely to be on 10-year US Treasuries, and then if you look globally, for much of the past couple of years, German 10-year rates were negative. They are positive now. They were as high as 30 basis points until this morning. Then now they're back down to zero. But investors around the world, before we'd say they didn't really have an option. They had to find something which gave them a yield. Now, if government securities are going to have a positive yield again, then it's going to be a little tougher to justify those valuations. So I think, from a straight sort of operational standpoint, multifamily assets look fantastic just because of rent growth and vacancies being so low. But from a valuation point, it's tough to tell. It's going to depend upon that path of rates.
Yes. And so just be careful out there. Again, I heard somebody at the conference, some group had just purchased a value add multifamily in Houston with a 1.5 cap. So I thought, boy, that sounds hard.
Yeah, exactly. And then there is policy risk too. I was just reading something this morning about Washington, D.C., where I work. It basically prohibits any eviction for less than $600. But we saw the halt on any evictions through the pandemic. That made sense from a public health standpoint. Those may linger. With the double-digit rent growth that I was talking about, that is causing a number of municipalities to look again into the idea of rent control, which, if you talk to an economist, that's about the worst thing that you can do, because it reduces the desire of anybody to build a new apartment building, which is the best way to bring rents down, is put more supply on the market. But I think we're going to be seeing more pushes at state and local level for rent control, and that obviously will cut right into that economic viability of those projects.
Yeah, very good point. Especially if we're seeing a younger demographic that maybe tends to lean that way, and voting for people who agree with that. Keeping rents down. I mean, we all want to keep rent. I mean, not all, but of course, it's important that people have affordable housing. It's getting harder and harder to provide that. So what about single family? Most of our listeners are buying 1 to 4 units nationwide. Do you see a further runway for single family? I mean, I know there's still such limited supply, but there's also new supply coming online.
Yeah. So, for me, I'm coming at this from a mortgage market standpoint. And so, my members in 2020, 2021 had the 2 largest origination years they've ever had, in the neighborhood of $4 trillion in volume per year, most of that on the refinance side. What we're looking at in 2022, our forecast is about a third drop in origination volume to 2.6 trillion, refinances dropping by more than 60%. And that's strictly a function of mortgage rates going up. It's already happening. We were already seeing it in the application data. On the other hand, mortgages used to buy a home, we think we're going to set an all-time record this year and go even higher next year. And that's on the back of increases in new and existing home sales and home prices continuing to go up. The biggest risk to that forecast, what you alluded to, is, for the past couple of years, struggling with lack of inventory on the market. We saw most recent reading 19% home price growth nationally. That is absolutely not sustainable. We're not getting to those levels like we did in 2006 because credit's too loose. We're getting to those levels because there's not enough homes to buy, right? It's a totally different issue. It'll be fixed by builders picking up the pace of construction, but they're running into so many supply chain constraints that's tough to do. I looked at the data on permits, on starts, on homes under construction. It all looks favorable for this year, even given those supply chain constraints. But for me, sort of the biggest tell is if you look at what we and others are predicting for home price growth in 2022. So in 2021, it said it was 19% home price growth. We're predicting 5%. Someone like CoreLogic is predicting 3%. Someone like Goldman Sachs is predicting 12% growth. That is an enormous range from people like me who spend, a lot of time looking at this data and trying to model it to make it come out right. So I think what you should take away from that is tremendous uncertainty here too about the ability of builders to successfully put up enough new units this year to bring home price growth back down to earth. And then the fact that builders are putting up generally sort of first move up or more expensive units. And the strongest demand is at the entry level with all the millennials reaching peak first time home buyer age. So there's a mismatch there. It can be fixed if people move out of entry level properties, put those on the existing home market for sale and move into new homes. But that's going to take a little time and not quite sure it'll all line up in 2022. Over the next couple of years, that absolutely is what's going to happen. But again, that home price path, very, very uncertain. I would say with a lot of confidence, though, I don't see how home prices go down in 2022, at least at the national level. If we run too hot for too long, 2023 becomes another story. There does get to a point where you run ahead of your buyers too far.
Yeah. Well, my prediction, if you care, is
Absolutely.
that it will just depend on the market, because it seems like there's still this these migration patterns where people with lots of money go into markets that seem so cheap to them and they drive prices up. I mean, Californians have been doing that for decades. We did that in Oregon and then Washington, Arizona, and
Idaho now.
Yeah. Now in Texas and Florida is just booming. Of course, that's probably more of the New Yorkers coming down, but also California. I know so many people who have picked up and left. They want to be by the beach, but they, want to pay a lot less for that. So would you say that would be true, that some areas might still see high price growth while others not so much?
So, I mentioned Idaho, that was the fastest home price growth in the country last year, north of 35%. But, you could not find slow home price growth anywhere in the country last year. It was all at least sort of mid-single digits. And it kind of made sense, right? The fastest growth where the highest population growth was. Absolutely, they're going to be, high-end parts of the market in the Midwest or, New York, other places that are losing population that are going to be more at risk. But, I would trust someone like you who's more sort of feet on the ground. I'm looking at big picture aggregates, which are important for sort of looking at some of the numbers I look at, but, absolutely, you could see weaknesses in certain pockets of the market, but I just can't see it being widespread given the overall imbalance between supply and demand.
Okay, that makes sense. So let's look at the big picture. Again, I listened to somebody this morning who thought we were heading towards recession potentially due to what's happening in Ukraine and the inflation and the readjustment of the forecast for the GDP. What are your thoughts on, are we headed towards a recession or not?
So I don't think it's likely. So me and my team get the privilege of once a quarter, we're part of the Wall Street Journal survey of economists that everybody highlights. And a question they always ask is, what's the risk of a recession in the next 12 months? Often we'll give an answer like 10%. So that's an unlikely number. Lately, we've been given a number like 20% or 25%. So it's not like it's a in your face kind of a risk. Mm-hmm. But anytime the Fed moves from unbelievably supportive policy to tightening policy, there's just always a risk that they go too far, too fast, and that pushes the economy into recession. I think that's the bigger risk right now. Mm-hmm. And the Ukraine situation just makes it even more complicated for the Fed because so uncertain about what the global environment's going to be, even if there's not so much direct impact on the US. So I think there's a risk of a recession over the next 12 months, but it's not the thing I worry about most. Again, I'm more worried about supply not showing up in the housing market. I'm more worried about a sort of misfire by the Fed in the sense that the market suddenly realizes that they mean what they say, and they are going to keep raising rates. Mm-hmm. If you were to get a big spike in longer term rates, that's obviously really challenging for the housing and real estate markets.
Yeah. I just did a talk at the Best Ever Conference on the changing tides. And you just said, anytime the Fed goes from super accommodating, printing all this money, so much unprecedented amounts of money that is circulating, and much of it finding its way to real estate, which is driving up prices. So much capital out there. And then when that shifts, it can take a little while because like you said, it's going to go slowly, but we are in that changing environment. Do you think that the Fed went too far in the accommodation and printing so much money?
I think the Fed acted appropriately in March of 2020. They, did not hesitate to provide all the liquidity the market needed. I think, the CARES Act that Congress, the administration passed, that was amazing. Usually our government, for all its strengths, that they don't act quickly, particularly when it comes to Congress passing legislation. And they did. And it was the exact right thing at the exact right time. And that was in April of 2020. By the time you get to the other bills that were passed, it might have been a little too much in terms of federal spending that was probably outsized for what was needed by the time we got to 2021. And then I think the Fed's been slow to recognize that there was a little too much stimulus hitting the economy. So I think their actions were right. Their messaging has been a little slow to adapt for my taste. But they all recognize it now. Every single one of them, you hear their speeches, they're saying, yeah, it's time to begin raising rates and shrinking the balance sheet.
Yeah, oops, it's not transitory, this inflation.
Exactly.
Mm-hmm. And that's an interesting point because there are still people, economists that I respect out there saying that this is still short-term inflation. It's going to go back to normal. And then I hear others say, oh no, it's here to stay. We're probably in a stagflation kind of place, which, I don't know when the last time we had stagflation. Was it the 80s?
That was the 70s, yeah.
70s?
Yeah. So, you look inside the inflation numbers, the headline number at 7.5, the core number at 6, those are the highest in 4 decades. And initially, inflation was getting pushed up by things that you could directly point. This is a pandemic-induced increase in prices, used cars, energy prices, other things that were just a result of supply chain constraints. But now the increases are across everything that consumers are buying. And to what we were talking about, most importantly, it's shelter costs. So cost of renting an apartment, cost of owning a home, together, those account for about 40% of the basket of goods that are core CPI. So if that measure is going to keep increasing, even if the pandemic-induced price increases reverse, on net, we're still going to see inflation higher than the Fed likes. And again, we were just talking about rent going up at mid-double digit, mid-teens in some markets across the country. The number entering CPI right now is 4%. So the way the BLS measures it, it's going to lag what we all are seeing in our sort of day-to-day work in these markets. So I just don't see how the Fed can quickly bring that inflation number down. Our forecast is by the end of this year, it'll still be between 3.5% and 4%, and the Fed wants to get to 2%. So that has us expecting the Fed to keep raising rates until they get the Fed funds target to about 2.5%. And again, we're starting from 0. So whether they get there in a small number of big hikes or a consistent stream of small increases over time, I think we're going to at least get to 2.5 by the end of this.
But you think they'll raise till 2.5?
Yeah.
Oh my gosh, yes, I've heard so many different opinions on that. Some say, oh, there's no way they can get past 1% because we'll never be able to pay our national debt of $30 trillion. What do you think of that?
So funnily enough, I was just reading a report from the Congressional Budget Office that was opining on exactly that point, that if the 10-year Treasury got to 3.5% in the near term, over the next 10 years, our deficit would be about $2.5 trillion larger, right? So it has an impact. It's large. It's not sort of out of line with what we've seen in terms of the swings previously. But what you'll really notice is that net interest payment on the debt, which is a fairly small line item in the budget right now, will grow to like the size of the defense budget if we get to a path like that. So it's not like we'll be unable to pay it, but it'll start to force some choices in terms of what we spend money on because it'll crowd out other spending.
Wow, that's a great response. Speaking of crowding out other spending, if consumers are dealing with inflation in everything that they buy, does that make them less able to buy a home?
So yes, you would expect that wage growth is gonna be a bit of a spiral here. When somebody sees that it's costing them 7-8% more on their bills each month, they're going to go into their employer, and in this job market, they're going to get listened to and say, "I need a raise," right? And there have been some recent reports of some companies are moving now to multiple increases in comp per year, as opposed to just the annual review, because people are having these pressures. Measured wage growth is sort of 5%, which sounds good until, again, you look at inflation at 7%. So people are falling behind. So is it going to impact their ability to buy homes? Yes, it makes it harder to save, but I think it's also going to be a bit of a spur, right? So if their landlord presents them with a 15% increase in rent for the next year, they might go out and start looking and might even be willing to stretch a little further to buy a home than they would have otherwise. Because what's the alternative, right? That they're going to next year be in a worse financial position if they have that 15% higher rent. So it's great that we're talking about both the multifamily and the single family markets, because obviously they're connected, and that person right on the margin between, do I stay a renter? Do I become a homeowner? They are comparing, okay, what would my rent be for the next year? What would that mortgage payment be? Obviously, with mortgage rates moving up, that payment's going to go higher. And with home prices going up, it does as well. But that rent isn't staying still. It's going up, right? And the only other thing they can do, and be curious your thoughts on this, you talked about people moving to lower cost housing or moving to other environments. The office situation is key to this too, right? If they don't have to go into the office every day of the week, they only have to go in 2 days on a hybrid schedule or something, doesn't that just greatly increase the geography on which they can look for housing and maybe find something a little less expensive? Are you seeing that?
Oh my goodness, we're seeing it all over the place. People had the tremendous flexibility over the last couple of years, but we're also seeing that starting to shift, where some companies just want to have their staff back in the office, and that's starting to pick up. So what seems to be more of a, for those who are truly able to be independent, they're in the tech industry or they're consultants and they can live anywhere. It's a wonderful opportunity. They can even go live in other countries that are much cheaper and make that work and still have a US salary. But in the larger cities like San Francisco, we're now seeing that just people spreading out into the suburbs or Sacramento, where they can still get into the city in an hour and a half, but they don't have to go every day, maybe just a couple of days a week.
Right.
So the suburbs are definitely growing, and the exurbs, the areas that kind of weren't doing much for a while, they're coming back to life as well, because a lot of people do want to be driving distance from the office if they do have to go in. So it's a mix, but at least at the conference I was just at, which we had one of the economic advisors for, I can't remember, a large commercial brokerage. And he said office is probably the hottest thing right now because the cap rates are still good, and people are wanting to come back to work. So we could see that change over the next couple of years.
Yeah.
We've been personally a remote company for 10 years. So it was nothing new for us. And I would think that over the last 2 years, a lot of companies learned how to do that and found online systems and structures and ways to make that work. For us, it works great. And then we get together every quarter in person. So it could be that some companies really are enjoying not paying that office. For us, it's wonderful to not have to pay for an office. We put that towards our quarterly retreats, bringing everybody together. So again, it could be that some companies have figured it out and they want to stick with it that way and don't want that office expense. But I spoke to a lot of the commercial companies that were at the best ever, and they're expanding their office space.
Yeah. Everyone I talk to, it's a different story. Which again, to the market uncertainty about where we're headed, here you have another uncertainty of just companies, even if they had made a solid decision in September of 2021, we're going to come back in January. That got blown up, right, with the Omicron variant, and so now it's sort of reshuffle the deck once again. Okay, well now it'll be March or it'll be April, what have you. So I think it's another big question mark on the outlook. But I think it absolutely impacts people's housing choices if they don't have to be in the office every single day. So curious to see how that evolves.
Yeah, absolutely. Okay, so what are your predictions for mortgage rates? We know that we'll probably see the Fed raising rates, but will you see mortgage rates continue to rise?
Yeah. So, we do a weekly survey with the mortgage rate, but the one that the industry sort of focuses in on is the one that Freddie Mac puts out every Thursday morning. That's been running about 3.9% in recent weeks. We think it'll be to about 4.25% by the end of 2022 and 4.5% by the end of 2023. If you look at a history, that's essentially getting us back to where we were pre-pandemic. So it's not a high rate by any perspective, but in the fall of 2020, we got as low as 2.7%. So that jump is why we think refinance volume really is not going to return to the levels between the last couple of years. But 4.5%, you look historically, that was a rate that home buyers could live with. It wasn't a problem at all. Home builders can live with it. So I think it's going to be supportive. I'm a bit more worried in the near term about the volatility in rates. If you've got a potential first-time home buyer who qualifies for the loan on Tuesday but not on Wednesday, that's got to be, really messing with their nerves. It's a challenging situation for both that customer and that loan officer, and trying to figure, okay, when do you pull the trigger and lock the rate? That's an impossible decision to make in today's market.
Yeah, and frustrating for sellers too. If they thought they had a buyer, that could be an opportunity for investors. But it does seem like with rents going up so much, I did read an article that there are 26 markets where it's cheaper to. I'm sure it's more than that, but there's an increase in the areas where it's cheaper now to own than to rent.
Yeah.
Because of that. And so maybe with mortgage rates going up, that could potentially keep some investors out of the market where they're not seeing as good returns. So maybe they back off and homeowners can come in and get more houses. We'll see.
Yeah.
We'll see. Okay. Let's see. Labor shortage. How do you see that affecting more supply, bringing in more homes, but also just businesses that can they afford to survive if they have to keep raising wages?
Yeah. So you look across the economy, there's still about 11 million job openings right now. Just as a comparison, that means for every person who's unemployed, actively looking for a job, there are 1.7 job openings. That has never happened before, right?
Wow.
If you're looking for work, it's never been a better time. A joke with some of my audience is that, if you have kids living in the basement downstairs, tell them to get out. This is the time to get a job. No more excuses. But from an employer's perspective, it's really challenging, right? And so that's why wages are going up as fast as they are, and expect that's going to accelerate further. And then closer to home, you look at the construction industry, that's where it's really binding. Builders have been talking for years that they face a number of constraints, shortage of vacant developable lots, shortage of skilled trades workers in particular. Now they got the supply chain constraints and lack of windows, garage doors, lumber, what have you, all of it impacting the cost and availability of what they need to build. But that labor constraint, it's a real one, and it's certainly an issue in terms of that supply potentially coming online. Again, coming even closer to home in the mortgage industry, I mentioned our forecast for a big drop in refinance volume. The industry staffed up to handle record years in 2020 and 21. So you're hearing about layoffs in the mortgage industry right now, and so it's always a bit of a counter-cyclical industry to what's going on in the broader economy because it's so rate sensitive, and I think we're seeing that again now.
Wow. Yeah, that's tough. All right. Somebody who just got trained and all of a sudden they don't have a job, but there's another job out there for them.
Absolutely.
Plenty of jobs. Yeah. Okay, wonderful. Any other predictions for us that you want to leave our listeners with?
I don't think so. I think we covered a lot of territory. It was so nice to talk with you.
So nice to talk with you. Thank you for taking the time to be here. And thank you for joining me here on the Real Wealth Show. If you'd like more information on this topic, I'm going to be giving a quarterly update at Real Wealth Network. You can sign up at RealWealthShow.com. That's coming up in a couple of weeks. Again, that will be my quarterly update, and you can sign up at RealWealthShow.com. It's free to join, and once you do, you'll get access to our investor portal, get referrals to different investor groups around the country who can help you find rental property with property management in place in this crazy wild market. I'm Kathy Fetke, and thanks so much for joining me here on The Real Wealth Show. We'll see you next time.
The views and opinions expressed in this podcast are provided for informational purposes only and should not be construed as an offer to buy or sell any securities or to make or consider any investment or course of action. For more information, go to RealWealthShow.com.